Okay, we're ready to start week 2 here of our Accounting 225 income tax class. Well, I'm going to start out with, and something that you should get very familiar with over the next 8 weeks for sure, but the quicker the better, is I want you to, for sure by the end of this class, have the 1040 pretty well memorized, at least how the layout is. That's one of the fundamental things in all of tax is that's the base main form for all individuals. I give you kind of a summary here that tells you what comes where, what comes first and second. So you can continue to look at this. I'm going to pull up an actual 1040 and go through it. I know we did this a little bit during our week 1 lecture, but I thought it would be good it's always good to go back through again and again the 1040 till you have it pretty well memorized. When you start up at the front, it's when we start doing tax returns next week in week 3, it is crucially important that you have the names spelled exactly right and the Social Security's numbers entered in precisely. If not, the returns will be rejected by the IRS. That not only looks bad on you, but it delays the potential refunds to any of your clients. This week, we're going to do everything there is to know about the filing status and the exemptions. We're going to hit that we're going to look into some details and see, well, what happens in this scenario? Can I claim the individual or not? And then next week in week 3, we're going to do some tax returns and introduce ourselves to the tax software. In week 4, we're going to look at lines 7 through 22. We're going to look at the middle part here of the 1040 on the front page. We're going to look at a lot of different income items. We're not going to look at every one because a lot of them have additional things that have to be done later. For example, here, line 12, you'll see you have to attach a Schedule C. We're going to talk about what the Schedule C is in the second half of the semester. For line 13, Schedule D is needed. We're going to talk about that in the second half of the semester. For line 8 here, the Schedule B, it's not required for any interest that you get under $1,500 total. And all it simply is just listing where you got your money from the interest from. It's not a big deal. It's not a big form. There's not a lot to know about the interest here. But we will hit that, especially what the tax-exempt interests are there in line 8B. Then we come down here, so that is in week 4. In week 5, we're going to look at things that we can take away from our income. These are called adjustments to your gross income. A big number that's going to be very important in tax, no matter which tax item you're looking at. A lot of them will ask for your AGI, which stands for your adjusted gross income. It's a number, it's a terminology that you just have to know for tax. Your AGI is the bottom number on your 1040 on page 1. And it's also then your top number that you start with on page 2 on the back side. So we're going to look at all these type of deductions when we get to week 5. In week 6, we're going to look at just Schedule A, the itemized deductions, and be able to tell usually pretty quickly when you are introduced to a new client if they are eligible to even do an itemized deduction. Or is it better for them just to take the standard deduction? So we'll look at that in detail. We did a little bit of the taxable income / looking up their tax last week in week 1, going to the back of the book there in the Appendix F, if they make under $100,000, and then being able to see, okay, taxable income of $40,000, married filing joint, they owe this amount of money. And then when we get to week 7, we're going to look at all of the different types of credits. And these credits are better than the deductions that you see that we looked at a little bit before. So it goes your income first, then some deductions. That it also then includes your itemized deductions or standard deductions. Then you look up your tax, and then the last thing is your credits. The credits are the better option, typically 95–99% of the time. So you usually want to use those if you at all possibly can. The other taxes in here, most of these are more advanced than what we're going to get to. We're not going to really do much. This self-employment tax, when you perform a Schedule C, when we do that the second half of the semester, the software will automatically calculate it for you, and it'll put that in there. The rest of these, the only other one that would possibly come up that's maybe a little bit more frequently is this first-time home buyer repayment. We can get to that in a much later semester. And then finally, after you subtract out all your credits, we're going to look at your refund or the amount you owe. Now, let's go back to our lecture notes. Oops, not that one. So I just went through all of this, getting to your adjusted gross income, your AGI, standard deduction minus your exemptions, and then going through and we subtract out our credits and get what we owe, or what we're going to get as a refund. Just as I was going through some of the 1040, I briefly hit on quite a few of these. And these, by the end of the semester, these you should know every one of these schedules. Just when I rattle them off, you'll know. If I say Schedule A, you should know that that means itemized deductions. If I say Schedule C, you should know that that means you have your own personal business. You're a sole proprietor. Some other forms that anybody associated with tax should know that you will run across if you ever do taxes professionally. The corporation forms, what they are. So if you ever hear of a Form 1120, that's what corporations fill out. And then instead of a Schedule C, if you're in a partnership, you do a Schedule 1065. A Schedule K1 is then taking the 1065 information and then showing how much income needs to go to each partner. Because partnerships are considered flow-through entities, whereas the partnership isn't taxed, the income is distributed to the partners based on how much percentage they own of the business. All right, getting into the more heart of this chapter this week, the filing status options. There are 5 different ways that you can file. The 3 most common are single, married filing joint, and head of household. So notice here with single, simply means it doesn't matter if you were married from January 1 through December 20th, and then your divorce was finalized on December 20th, you would have to file as single, even though you were married for 12 months of the year, or almost all 12 months. It's what are you at the end of the year. Married filing joint, same thing. If you get married the last day of the year, or anytime that last week, even though you were single the whole year, you would file as married filing joint. This also is the case even if your spouse dies throughout the year. If your spouse dies February, so you were widow for most of the year, you would still file as married filing joint. Something that I would say only maybe 5% or maybe even less of married couples do is do married filing separate. Most of them don't do it because they think that's the better option. They do it because it's maybe the only option. Very few do married filing separate because it's a better option for them than married filing joint. Again, maybe only 5% finding it as a better option. If anybody else does it, they do it mainly because they have to, because they're still technically married, but they're not on speaking terms with their spouse. Their spouse doesn't want to give them their Social Security number anymore. The spouse isn't there to sign the return. They're gone for whatever reason. So that's when you would do head of married filing separate. The only option to not do married filing separate, and if you are still legally married, is this one. The only exception, and this is one that you should know because it will come up, is if the spouse that has come to you, if they have not lived with their other spouse, have not seen them since at least half of the year, since July 1, and they have kids at home that they take care of and they claim as a dependent, they can claim head of household, which is a better option than married filing separate. Married filing separate is essentially the same as filing as single, but you have a lot more restrictions. Married filing separate is generally not the way to go. So remember the exception. If your spouse has not lived with you and you have not been with them for the last 6 months, and you do have kids at home and you take care of them, they are your dependents, you can file for head of household. So that takes us then to what is head of household? Well, head of household is a step up from being single. You get a better standard deduction, more money to take off of your income. Married filing joint is the best one because it's basically two singles together. So you get two single numbers and then add them together. Head of household is kind of in between, like 1.5 times. To be head of household, you need to A, keep up the cost of your home, or paid for more than the cost of your home. So therefore, if you lived on the street, you lived in a shelter for most of the year, you wouldn't be able to claim head of household, even though you may be able to claim a dependent, because you didn't pay over half the cost of upkeep for the place where you lived. And as you can see, things that count as payments for that. You can include all of this in to see if you paid for over half the cost of keeping up your home. So just because somebody else paid all the rent, if you were responsible to pay everything else, the insurance, repairs, utilities, whatever else it is eaten, or food eaten in the home, and you split that with your roommate, you could still possibly claim head of household. Things that you would not then include would be clothing that you provide. That's not part of keeping up a household. And to claim head of household, not only do you have to pay for over half the cost of your home, some people think that that's all you have to do, and that's where a big misconception. I'll have people come into me who are single, keep up half the cost of their home or all of it, and they say, I should be able to claim head of household. But the other rule is you have to have a dependent living with you that qualifies as a qualifying person. The only, again, there are a lot of exceptions in tax. There is one exception here too. So typically to claim head of household, you have to have a dependent living with you. The exception is if your dependents happen to be your parents, you claim possibly elderly parents. The parents can still live on their own, but as long as you pay for over half the cost of their home that they live in, then you can claim head of household for tax purposes. And so notice here I put qualifying person. The qualifying person has to be a relative. It cannot just be a roommate from college that lives with you. You cannot claim head of household just because your dependent, your roommate, you claim them as a dependent, and therefore you want to claim head of household. It doesn't work like that. To claim head of household, it does have to be a relative, usually a child, parent, an aunt or uncle would also be okay, but cousins are not okay. Cousins are specifically not considered a qualified relative for tax purposes. So if you consider a cousin your dependent and they live with you, that would not be enough reason for you to claim head of household. You would still have to claim single. The last item that you could possibly do as a filing status is surviving spouse. And surviving spouse is only available for those who were married. And then the year and the second year after of the death, you can claim surviving spouse both of those 2 years, and only if you still maintain the home for a qualifying child. Okay, so very, very few can claim surviving spouse. And when they do, they can't claim it for only 2 years. In the year of the death, again, you claim married filing joint. In the following 2 years, if you still have a child at home that you claim as a dependent, you can claim surviving spouse, which is just like filing married filing joint. You get the same benefits. Okay, so the next piece, after you've figured out your filing status, and we're going to go back through some exercises here in just a little bit. But next, once we've figured out our filing status, we need to determine, can I claim somebody as a dependent? And if so, how much do I get to take off my taxes for every person I claim? Well, that number changes every year. For the year 2016, which was the most previous tax season that just passed in February, March, April of 2017, we always do the taxes in the year back. So we do the taxes for the 2016 year. So for 2016, and that's the tax return, or that's the tax software we currently have for this class. Generally, the new software doesn't come out till around November, maybe a little earlier, October, November, but definitely not in time for the class to start. So sometime either in the spring or the next fall is when I update every year. So if you're watching this in a later semester than the fall of 17, that number, always look at your notes because I'll have those updated. I won't necessarily always update this video for every single semester that things change. So you think, I get to take off for every dependent I claim an extra $4,000 on my taxes, which is great because then I don't have to pay tax on that amount of income. So when I said before last week, you don't want to look up in the back of the book, your gross income. You want to look up your taxable income. And your taxable income includes taking off $4,050 for every single person you claim on your return. So that includes you, your spouse, and then any other dependents. So personal exemptions. You can see here I have personal and dependency exemptions. The personal exemptions are only there for you and a spouse. That's it. Anybody else is considered a dependent. So that's just something to keep in the back of your head to remember. Personal exemptions are just for you and your spouse. You cannot claim, as you can see here, you cannot claim yourself as an exemption, a personal exemption, if somebody else claims you. Not just if, but if they can claim you. I want to specify that. I even said it not quite right. If somebody else can claim you, even if they don't, if they are eligible, they meet all the guidelines, they just choose not to, you still wouldn't be able to claim yourself. So it's best if they go ahead and do claim you. That's how the tax law is specifically worded. If you can be claimed by, say, a parent, they meet all the rules, then they should claim you because technically you're not allowed to. So personal exemptions, just you and or your spouse. Dependency exemptions, so those are all the other people that you could possibly claim. There's two different types of a dependent. You can have a qualifying child or a qualifying relative. A qualifying child, these are the better of the two. As you'll see in a little bit, they give you more areas of possible credits later on. Now, they all mean the same for getting a dependent deduction, the $4,050. But usually a child will give you different items like earned income credit or child tax credit that we'll talk about later. So a qualifying child, who counts? Well, as you can see here, it doesn't necessarily just have to be an actual child of yours. It could be a brother or a sister or any descendant of your child. Maybe it's a grandchild or any descendant of your brother or sister. So a niece. The only thing that doesn't count here really is taking care of a younger cousin. That would not count. Or potentially a parent. They wouldn't qualify obviously as a qualifying child. But a brother or sister would qualify as a qualifying child as long as you take care of them, so they're going to be younger then as well, or unless they're handicapped. So another requirement, so A, they have to be your child or thereof or a descendant. They have to meet age requirements. So not just anybody can be a qualifying child. They have to be less than 19 years old. So there's two different ways of saying that. You can either say they have to be less than 19 or 18 and younger. Depends on how it makes more sense to you. Or they can be up to the age of 23 as long as they're a full-time student. And note here, a full-time student for at least one semester. That means if they are 23 and they graduated that spring from college in May, you would still be able to count them as a dependent because they were enrolled for at least one semester full-time. The other requirement is They do not have to be under 24 if they are permanently and totally disabled, meaning they cannot take care of themselves. Qualifying child, again, I'm kind of restating here, but it can be a brother or sister, but only if they are younger than you. The exception is if that individual is disabled. The final criteria to be considered a qualifying child is they've had to have lived with you for at least greater than half of the year. You didn't necessarily have to pay for the housing, so as long as they lived with you in maybe a shelter, that would be okay. Even if you didn't pay for their housing, as long as you paid for, we'll see here, paid for over half of their expenses. Okay, exceptions for children of divorced parents. Who gets to claim the child in the issue of a divorce? Well, the first rule goes to if there, now again, this is going to dictate if there's a court order. If in the divorce decree there's a court order that says the father gets to claim the child every other year and the mother gets to claim him then the following years, then you would follow that. If there is no specific order, then the child who was in custody for at least half the year gets to claim the dependent. And as long as the parents paid for over half the support, or if there's a divorce decree and there's some kind of a waiver that says, even though the child didn't live with me over half the year, the divorce decree does specify that I can claim the child every other year. Or the parent, the custodial parent, can actually sign a waiver that says, I will grant you this child and you can take them on your taxes. However, notice this is pretty important. The custodial parent, even in the situations where they did not claim their own kid because of, say, a divorce decree, that parent can still claim head of household even though they're not claiming the kid as a dependent. So there is a rare situation here where you don't have a dependent listed on your return, but you're still able to claim head of household. If that happens, then there is a box up in the filing status in the head of household that says, enter the child's name and social security number here if you did not claim them as a dependent. And that would be the situation. You did not claim them because of some divorce decree. The custodial parent, even if they don't claim their kid, can still take any dependent care expenses they pay for. So if they pay $200 a week or whatever it is for child care, because they're the custodial parent, they're the one that takes care of it, they can still take that off on their taxes, as we'll see in later weeks. The custodial parent can also claim earned income credit. How that then flips is the non-custodial parent, even if they can take the child as their dependent for that year, they cannot claim these. That non-custodial parent cannot claim head of household because he was not the head of household for the child, unless he had another child that he was considered the custodial. The non-custodial parent could not claim earned income credit for that child or any dependent care expenses that were paid by somebody else. So therefore then, the non-custodial parent who claims, just because the divorce decree says they can only take, and this year it did go up, $4,050 off their taxes, and they can also then qualify for the child tax credit. So if you look here, when you claim a child, there are 5 potential benefits that you can claim, that you get access to every time. So if you're married filing joint, or excuse me, if you're single, I don't want to use married filing joint. If you're single, there's 5 different benefits. However, in the divorce situation, the person who actually claims the child, who doesn't have the child living with them more than half the year, can only claim 2 of them. The non-custodial parent, or the custodial parent, can still claim the other 3. couple other of the final rules here for claiming a qualifying child. The child did not support at least over half of their own support. And notice here that one of the rules of the tax law says a person's own support funds are not support unless they actually win. So if you have a 17-year-old child living at home, they're still a senior in high school, but they do make quite a bit of money on a side job. Maybe they make $10,000 a year. As long as that money is put away in a bank account and not actually spent to help take care of themselves, then that doesn't count towards their support. Whatever money you paid that actually went to their support does. And the final thing here, the child must be a U.S. citizen or a resident of U.S., Mexico, or Canada to be eligible to be for a child dependent. All right, so some common issues that come along when you're dealing with a more of a blended family is, well, what if 3 generations live together? Grandma, mom, and daughter. Remember, to claim a kid, they not only can be your son or daughter, but they could also be a descendant of that. So you could claim a grandkid. So if mom and grandma both live in the same house with the child, actually both of them would be able to qualify, perhaps. But even if both of them qualify, only one is allowed to take the child as their dependent. So sometimes they can decide among themselves. If they can't decide among themselves, what happens then is mom can let them. If mom generally would be able to claim the kid, mom has the ultimate rights, but mom can let grandma claim them if she has a higher AGI. So notice here, if there's ever a dispute, the parent ultimately does get to claim the child. Note, so then remember I said mom can let grandma claim them if grandma has a higher AGI. If mom is the one with the higher AGI, the adjusted gross income that we talked about early on in the lecture, then only mom would be able to claim it in that situation. So that's something that happens in everyday life that we run across. So it's something you want to be aware of. The next common issue, well, what if mom and dad of the child were never married, but they live with the child? What happens then? Well, either parent can claim it as long as they agree. And whoever claims the kid can also then claim head of household and the earned income credit. The other parent cannot claim head of household because they're not claiming the child. And it's not because of a divorce decree. Now, if there's ever a dispute, say mom and dad are not married and there was maybe a reason why they weren't married, they don't get along that well, and they both want to claim the child, well, these are the tie-breaking rules. So if either one is not the parent, then the parent would win. If both of them are parents, the parent that had the child living with them more time would win. And then finally, if they both happen to have the child exact same, equal 50% both, then the one with the higher AGI wins. Remember, every dependent that is ever claimed can only be claimed once. If they're claimed more than that, the IRS will reject it. And that happens quite often. People are claimed and then other people didn't know that someone else claimed the kid. So that was all about a qualifying child. The next part is the qualifying relative. So just because they're not a child doesn't mean you can't claim them as a dependent. If they fall under the qualifying relative, you still may be able to claim them. First rule to be a qualifying relative. The first rule is they can't be a qualifying child of someone else. If they fall under that rule that they are considered a qualifying child, then you can't claim them. Unless, the only exception, you can claim another qualifying child only if that parent who could claim them doesn't file, or only files because they're getting a refund, but they weren't required to file. And that leads me, you think, well, how do I know if I'm required to file? That's a really good thing to think of. That if you go back to the syllabus and where I have the books, or the books that are good to have for this course, I have a link there that says the IRS VITA website. And then also back in the IVY Learn at the very top in the resources, I have something called help pages, help spiral pages. And these help spiral pages, I went through something that I got from the VITA site, and I pulled out different items that I thought were the most relevant for our class. This first page deals with, well, who exactly must file? If you're married filing joint, both spouses are under 65, you don't have to file if together your gross income was $20,700 or less. If it's over that, you are required to file. So you may, even if you had income of only $20,000, you may still decide to file just to get your refund. So that's what this is talking about here. You can't claim another person's qualifying child unless the parent was not required to file or only did because to get their refund. The second test of the qualifying relative, they have to be a member of your household or, and that's a big or, a relative of yours. Relative, again, does not mean cousins. A member of your household. So they must be related, and if they're related, they don't necessarily have to live with you. Or if they're not related, like a cousin, they have to live with you to be considered a qualifying relative. And they have to be related to live with you the entire year. So, key takeaways from this with a qualifying relative. Person does not actually have to be a relative. I think that's kind of weird. To be a qualifying relative, you do not actually have to be a relative as long as they live with you. And to be a qualifying relative, if you are a relative, you do not actually have to live with them to consider yourself them as your dependent. Again, cousins are not dependents. Probably the biggest stumbling block to not be able to claim somebody for a qualifying relative is how much money did they earn last year. If they earned over just even $4,050, which is the exemption amount, if they earned more than that, then you can't claim them. Notice there was no such requirement for a qualifying child. A qualifying child, the only requirement there is that they don't provide over half their own support. They can make $10,000 if they're maybe a senior in high school, and that's potentially could happen. With this, if a person makes $10,000, still not a lot, you're probably still going to have to support them, but you would not be able to claim them on the tax return. So taxable income, remember this is taxable income, $4,050. That's not a lot, but there are some things here that they could still get money for, live off of, and it's not counted as part of this taxable income. So if they would happen to get tax exempt interest or Social Security, scholarships, refunds on scholarships, those would still be money that they could get, and it's not considered taxable income. And the final requirement here, like with the child, the taxpayer provides over 50% of their support. So what consists of support? Well, this is more broad. The head of household we looked at only did like the electricity, the utilities, the rent, maybe the mortgage payment, real estate tax. This includes a lot more items when you talk about support. Who paid for that person's food, their education, maybe their medical care, any fun things that they did. Lots of things go into that. And then here are just a few items to not include in their total support. Scholarships received by your child if your child is a full-time student. So that does not necessarily go towards that child providing their own support. If one person, let's say you have an elderly parent, but then you have a couple nieces and maybe a brother or sister or whatever, and they all help to provide support to an elderly person. If, as we see up here, the person cannot provide over half, the taxpayer has to provide over 50% of the support. There's one exception there, and that's if multiple people provide over 50%, then one person can claim it as long as everybody agrees, and as long as that one person did provide at least 10%, and no one by themselves supplied over 50, then you can come together as a family or a group and decide who's going to claim each year that individual. Finally, they must be as the child a U.S. citizen or resident of U.S., Mexico, or Canada. I'm going to skip past this support because I want to keep going because I think these are more important here. What I want us to do here, and we'll go through the scenario, and then what I'd like for you to do is pause the video, think about your answer, and then unpause it, and I'll go through the answers, but I'm going to go through them pretty quickly, so I'm only going to pause for about 2 or 3 seconds. That'll give you time to pause the screen, think about your answer, and then click play to see what the answer is. But what we're going to do is decide how many dependents can the individual claim in total, and what would the taxpayer's filing status be. All right, so let's do this. In example A, I tried to make up some different situations that could occur, some of them kind of normal, some of them a little bit more rare, but even the rare ones do happen. So we have a taxpayer who is single, 2 kids. One of the kids is 20. Keywords here, they go to school part-time, and they make $2,000. The other is a 17-year-old who earns $5,000. Both kids live with the taxpayer, and the taxpayer provides over half the support for both. Can the taxpayer provide any of the, how many exemptions can they keep? Notice I put here dependency exemptions. That would not include the personal exemption. And what filing status would this taxpayer do? Single or head of household being the primary two. Okay, go ahead and pause. Think about it, and then let's go on to the answers. So with A, this individual could claim both children as dependents. The first one would qualify as a qualifying relative. They're not a qualifying child because they're over the age, and they're not a full-time student, but they made less than $4,050. So they meet the income requirement for a qualifying relative. The child, it doesn't matter what they make. I mean, the 17-year-old child, doesn't matter what they make. They would be considered a qualifying child. They are under the age limit that's necessary. So this individual could claim 2 dependents and file head of household. All right, the second one here. The taxpayer provides over 50% of his uncle who lives across town. Uncle earns $3,000. None of the additional $10,000 is taxable for that he gets in Social Security. So he works maybe a really small part-time job and does earn $3,000 on the side. How can the taxpayer claim this person as a dependent? Can they claim head of household, or must they claim single? Hopefully you will pause and just think about it, write down your answer. All right, the key things with this part B is, yes, they can claim the uncle as a qualifying relative. Remember, to be a qualifying relative, as long as you're a relative, you do not have to live with the taxpayer. And as long as the taxpayer did provide over half the support and you didn't have taxable income of over $4,050, so they met the guidelines there. However, they do not meet the guidelines for head of household. For head of household, the individual has to actually live in the household with you, with the only exception being a parent. Uncle does not qualify to do that. So the individual would have to claim single, even though they get to claim the uncle as a dependent. Part C. Taxpayer has 100% custody of both kids. Sounds like a divorce type situation. However, the divorce decree does allow the ex-spouse to claim each child. And there's 2 of them. Parents together provide over 100% support. In addition to the main questions above, also answer who can claim the following: the child tax credit, dependent care, if any, and the earned income credit. All right, so take a minute and think about this. Think about it from the taxpayer's perspective, who does have the custody of the kids. However, for this year, the ex-spouse is claiming them as a dependent. And then what can the ex-spouse do? Okay, the answer for this one is, of course, the taxpayer would not be able to claim either of the kids as an actual dependent. However, the taxpayer could claim head of household in this situation. The taxpayer can claim any dependent care if there was paid. The taxpayer can claim any earned income credit, even though they didn't claim the kid. However, the taxpayer cannot claim the child tax credit. However, the ex-spouse can claim the 2 dependents. The ex-spouse can claim the child tax credit, but the ex-spouse cannot claim the dependent care that was spent elsewhere or any earned income credit. The ex-spouse must also file as single. So go ahead and pause it at that point if you need to see the answers. And at this point, I think it would be a good time to take a break, stretch, and we will start a second video to go through the remainder of these exercises as well as the remainder of this chapter. This is our longest chapter, but I think it's the most important, so that's why I do require this.